what is an NFO and what is an IPO? What is the difference between these two and which is better? Our chief financial planner, Mr. Ramalingam, will give insights on this. Ramalingam, over to you.
NFO is from mutual funds, new fund offer. IPO is for shares, initial public offer. What's the difference if you ask me? When a company is issuing shares, it is called as IPO, initial public offer. In the share issue of IPO, there is a limited number of shares available in the market. So if I am applying in an IPO of a stock share, there's a possibility I may get allotment, I may not get allotment, I may get partial allotment. Whereas in an NFO, new fund offer, there is no limited units, unlimited units are available. Whoever is applying, they will be getting allotted. So there is no supply and demand mismatch here. Whereas in an IPO, if there are more takers, people who want to subscribe to that IPO, it can be oversubscribed. To that extent, when it's getting listed, it can list for a higher price. Whereas in an NFO, just because more people are investing in that NFO, there is an euphoria about that NFO. When it is getting listed, it will not have a good demand because NFO allots units for everyone who applies. That we have to clearly understand. This is basic difference between IPO and NFO. IPO and NFO may look similar, but they are completely different. In IPO, you know about a company which has got a minimum track record is what apply for an IPO. So you will have the balance sheet of the company for last 3-5 years. You will have a P&L. You can do a cash flow statement. You can do a cash flow analysis. What is the PE ratio? What is the PP ratio? Everything we can check up, and based on that, we can decide to invest in that stock or we can avoid that stock. Whereas in a mutual fund simply announces an NFO, collects money from you and me as investors, and in turn, after the NFO is closed, they will decide where to invest that money, in which portfolio to invest. So what is actually happening here is in the new fund offer, we don't know where our money is going to get invested, in what kind of portfolio. And number two, there is no track record. How the fund is performed in the past, we don't know. So it is simply a new fund offer. Because we don't know about the track record and there is no portfolio, we are simply taking blind risk here. So NFO and IPO both are riskier because we don't have, in IPO, there is no price discovery for that stock. What is the price? We have not discovered. Rest of the stocks, because of demand and supply in the market, we know what is the price. Price discovery will happen only after the share is getting listed. Till such time, there is no price discovery. The issuer, the promoter may be pricing it too high. So if you subscribe during IPO, you have to pay that price. When it's getting listed, it may get listed for a lower rate. Say in 2008, Reliance Power came with an IPO with an exorbitant pricing. But when it got listed on the same day, the price went down heavily. All subscribers lost money. People who bought it in the secondary market got benefited. So that way, both NFO and IPO are riskier. So go for a stock which is already listed and price discovery has happened. Similarly, NFO also, there is no track record, there is no portfolio, but to go for an existing fund generally.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.